Altria Group, stock ticker MO, just released their latest quarter's earnings and the stock is up big as a result. Look at the past 5 days. The stock is up around 8.23%. They're trading at about $50 per share and then jumped all the way up to around $54 to almost $55 per share. So they're pretty much at their 52-week high right now. And if we look at the past year, we can see they're now up almost 35%, and that doesn't even include the dividends. In fact, if you would have bought this stock exactly 1 year ago today, let's see what that would look like. Your starting dividend yield would have been close to 9.5%. So you're talking about a stock that's seen around a 35% return as well as a 9.5% starting dividend yield as of 1 year ago. So your total return is almost 45% if you've been holding this stock over the past year. Now, as of right now, we can see even after the big run up in share price, this is still a big dividend payer. The company currently has a yield of about 7.5%. Now, let's go ahead and dig into the latest quarter's earnings. We can see they beat on top and bottom lines. Q3 non-GAAP earnings per share of $1.38 was a beat by around 3 cents, and revenue came in at about $5.34 billion, which was a beat by about $10 million, and was up about 1.1% year over year. So there's no doubt this is not a high growth company, but they did beat expectations, which is a good sign to see. And perhaps what's even more important is they reaffirmed their guidance to deliver 2024 full year adjusted diluted earnings per share in the range of around $5.07 to $5.15. So again, you always want to see companies either raising or reaffirming their guidance. And this would put their adjusted diluted earnings per share growth at about 2.5% to around 4%, which is pretty close to what management has been targeting for this company lately. Now, when it comes to Altria, obviously the big reason people buy this company is because of the big dividend payments. And the questions people always want to know is how sustainable is that dividend? Will that dividend continue growing? And we're going to address those questions as well as dig more into this earnings presentation in this video and also talk about what is the fair value of Altria? What price should you be paying for this company? So let's go ahead and start digging into it. Now, first off, keep in mind, just a couple months ago, Altria increased their dividend payout. They increased it by about 4.1%, which is a pretty decent dividend hike for this company. It's above the rate of inflation, and they're already paying out massive dividends. So overall, this is a good sign if those dividend payments are sustainable. So let's go ahead and jump over to my dividend breakdown sheet. We'll come up here and plug in stock ticker MO, and you can see all this data will load in. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now, the first thing that jumps out to most people is going to be these payout ratios, and that's very understandable. At first glance, they are pretty high, and there's no doubt that it's true. Earnings payout ratio in 2023 was about 83.38%, and the free cash flow payout ratio was sitting at about 75%. But there's something you have to understand about Altria, and anytime I mention them, it's important that I bring this up. Management team has made it clear that they're targeting a payout ratio of 80%. So when it comes to their capital allocation policy, they've decided the best way to reward their shareholders will be in the form of dividend payments. So you have to understand this isn't by accident. This is completely by plan from the management team. Now, that being said, can they maintain those high dividend payments with a high payout ratio? We can see they've been increasing dividends for quite some time now, and in fact, this company is a dividend king with over 50 consecutive years of dividend increases. We can see a 10-year dividend CAGR of about 7.4% and a 5-year sitting at about 4.5%, so pretty decent dividend growth. And the reason they're able to increase those dividends is we can see over the past decade, the free cash flow for the company has been growing. In 2013, free cash flow was about $4.2 billion, and in 2023, it was sitting at about $9 billion. So that's a 10-year free cash flow CAGR of close to 8%. Now, in the past couple of years, it's slowed down a little bit. It's sitting at about 2.2%. But overall, we can see that free cash flow payout ratio has been staying in the range of around 80%, just like management has been targeting. Now, if we look at their investors presentation they just put out with their earnings report, we can see they paid about $1.7 billion in dividends in the third quarter, and they increased their dividend by 4.1% in August, which was their 59th increase in the past 55 years. That's pretty phenomenal. But one of the things we also have to understand is how share repurchases impacts the way that they pay their dividends. This is something a lot of people don't understand, and we're going to address it in this video. We can see in the third quarter, they repurchased 680 million of shares, but approximately 310 million is still remaining under their currently authorized share repurchase program, and they expect to complete by the end of the year. So what does that mean? Well, they're going to use $310 of capital to buy back shares over the next quarter. Now, how does this impact their dividend? And you may be wondering, what do you mean, how does it impact the dividend? We're talking about share buybacks. Well, let's go ahead and take a glance at this. If we jump back over to my stock screener sheet, I want to look at quarterly data, and you can see I've already plugged in MO, and what we're looking at here is the quarterly shares outstanding for this company over the past decade, and we can see a gradual decline. But we're going to do a little case study here, and this will likely change the way you think about share buybacks, specifically with companies that pay dividends. If we come over here, we can see in 2023, Altria had around 1.77 billion in shares outstanding. Now, how much do they pay out in total in dividends in 2023? Well, we can easily find this by using the ticker data function. We'll come over here and select Altria, and then we want to indicate that we want the amount paid in dividends, and then we want it for 2023, and I'll hit enter. And we can see in 2023, they paid about 6.77 billion in dividends. So if we come over here and take this number and divide it by the shares outstanding, we can see it comes out to about 381. That number would look a little bit different due to the timing of things like dividend hikes and share buybacks. But here's where things start to get interesting. If we come back down here and look at 2024, again, we'll use the ticker data function. We'll come up here and select Altria, and then we want weighted average shares outstanding right here. And this time we want it for 2024, and we want the most recent quarter of data, which is going to be Q2. They just released a Q3, but it hasn't come in yet. And so we can see as of Q2 2024, weighted average shares outstanding is lower than in 2023. It's down to about 1.7 billion. And then if we come over here, we have dividends paid again, but they haven't paid out all their dividends yet in 2024. But let's do a hypothetical. Let's say they were to pay out the exact same amount in total dividends as 2023, which is obviously not true. They're going to pay out more. But look at this. If we take dividends paid and divide it by shares outstanding, we can see this time it's $3.95. Why is this? Well, it's because there's less shares outstanding. Even if they paid the exact same amount out in dividends as they did last year, the dividend per share would actually be even higher because there's less shares outstanding. And so simply from decreasing their shares outstanding, we can see the growth rate of this. The dividend per share growth rate would be around 3.43%, again, without increasing their dividend payouts in this scenario. And what we just saw from the investor's presentation is they have approximately $310 million of capital to buy back. So if we go back over to our example again, about $310 million to buy back, keep in mind they'll be buying these back at different prices. But if we look at the current price of Altria using the ticker data function, we want MO, then we just want price. We can see as of this moment, they're trading at $54.27. So if we come over here and we select the amount they're buying back, divided by shares outstanding, we can see they're going to be able to buy back about 5.7 million shares outstanding. So if we assume after the Q3 and Q4 share buybacks, Altria could be sitting at about 1.64 billion shares outstanding, and assuming the same amount paid out in dividends as 2023, for just an example, we can see just how much that dividend would increase based off the shares outstanding. It'd jump up to about $4.13 per share. So you can quickly see why buying back shares for a company like Altria can increase their capability to pay out dividends. So when you combine these share buybacks with the fact that they did just increase their dividends at about 4.1%, things are looking pretty good from a dividend perspective. Now, if we start digging into this earnings report just a little bit more, like we just saw, they reaffirmed their full year 2024 guidance range, which is definitely a good sign, expecting earnings to grow at about 2.5% to 4%, which is probably to be expected for this company. It's obviously slow growing, but we can see third quarter growth was up about 7.8%, and compared to the first 9 months of 2023, they're up about 1.6%. Now, if we scroll down to the 20th slide, here's something else we can see. Smokable products segment, adjusted operating companies income up about 7.1% versus the third quarter in Q3 and up about 1% for the first 9 months. But this is where things get interesting. Let's talk about smokable products margins. We can see the margins for this company are actually increasing, and this is a really big deal when you think about a more mature company. And for example, if we go ahead and jump over to my profitability sheet, come up here, you can see I've already plugged in MO. We can see the 10-year average gross profit ratio for this company sitting at 62.72%, but the 2023 gross profit ratio was about 69.67%. So we can see the profitability of this company is increasing over time. And that's because they have a lot of pricing power, and like we just saw, it looks like they're continuing to get better margins in 2024. This is a big deal for the company, and it's part of the reason that their free cash flow is continuing to increase every single year. Now, if we jump back over to the 30th slide, we've already glanced at this, but I want to show you something else. Look at the company's 2028 enterprise goals. One of the big ones for this company is a target debt to consolidated EBITDA ratio of approximately 2 times. Well, if we go back to that recent earnings report, we can see as of September 30th of 2024, they're sitting at about 2.1 times total debt to EBITDA ratio. So they're actually pretty close to achieving that goal. They're right where they want to be in that aspect. We can see the company's also targeting a dividend goal of mid-single digit growth dividend per share. And then their earnings per share compounded annual growth rate target is mid-single single digits. So overall, the market seems to like what they've seen from this earnings report. Now, with the recent run up in the share price, we have to ask ourselves, is this company still trading at a good value? And to answer that question, let's go ahead and jump into my stock valuation spreadsheet and come up here and plug in MO. And again, all this data will load in, and before we glance at that first valuation, I do want to point out the beta is relatively low for this company, which some people like, especially if you're later with your dividend investing, because you want low volatility. Now, the first valuation we're going to look at is going to be Graham's valuation. If we come over here, we can see the formula Benjamin Graham laid out for us to calculate intrinsic value. We're going to use the estimated earnings per share for this company at 5.11. We have a low growth rate projection, and then we're going to divide this all by the current yield on AAA corporate bonds, sitting at 4.95, which, keep in mind, the higher this is, the more the valuation will go lower. And if we look at this charted out over the past few years, it's quite a bit higher than it has been historically speaking. For example, in the middle of COVID, it got as low as 2.14. And I want to show you how much this impacts the valuation, because right now we're sitting at 4.95, but on average, typically over the past few years, it's been closer to 3, and look how much the intrinsic value would jump up if that were the case. But for now, we're sitting at an intrinsic value of about $45.42 with Graham's valuation. Now, the next valuation we're going to look at is going to be our discounted cash flow analysis. We're valuing the company based on how much free cash flow we expect them to generate in the future. Now, we're projecting a low free cash flow growth rate, about 2%, pretty close to what management is expecting. So we find the future free cash flows of the company using that growth rate, find the present value of those future free cash flows and add them together, add the company's cash and cash equivalents, and subtract out their total debt to get equity value, divide by shares outstanding, and we come to a DCF price per share to $63.29. That's pretty interesting. Now, the last valuation we're going to look at is going to be our dividend discount model. We're valuing the company based on how much they're paying out in dividends and how much that dividend is increasing over time. So I'm projecting a dividend growth rate moving forward of 2%, and with a discount rate of 9%, we come to a dividend discount model price per share of $59.45. So when we jump over to the output tab, we can see our three valuations, $45.42, $63.29, and then dividend discount model at $59.45. And so when we average those three together, we come to an intrinsic value of about $56.05 per share, really close to that current trading price. I think for the longest time, Altria has been a company that's severely undervalued. If we jump back over to Seeking Alpha, we can even see right now, their forward-looking price to earnings multiple is just 10.66. That is far below the average S&P 500 company. Yes, this is a slow-growing company, but they're still growing earnings. They're still growing free cash flow, and you're getting huge dividend payments that are actually growing. And this is a company I added to my portfolio when it was trading in the low 40s, and I've seen pretty good growth from them. If we come down here, you can see I'm currently up around 38.17% on this position. I don't typically buy companies with a starting dividend yield as high as Altria, but I actually believe the company was undervalued. I thought those dividend payments were sustainable, and they can continue to grow those dividend payments at a low rate moving forward. But after this recent run-up in share price, it does look like Altria is trading quite a bit closer to fair value. But go ahead and let me know what you think of Altria in the comments down below. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.